Hello, good morning, good afternoon, or good evening, depending on where you're watching this webinar from. Thank you for joining this webinar where we'll be looking over should you purchase your next buy-to-let investment rental property within a limited company. We have a team of experts with us today, and we'll, introduce ourselves as we go through the webinar from the taxed and complete RPI as well. Awesome. Just to add, this is an interactive webinar, so if you do have any questions throughout, feel free to add it in the chat. I will post the comment in the chat now, so feel free to ask any questions in here, and we'll be able to answer those questions as we go along. But then as well, just to kind of talk through the agenda for today, we will be looking at, we had a quiz planned, but there was a bit of a technical issue, so we'll see if we can get that working, but if not, we'll jump straight into some of the pros, the cons, and things that you should be thinking about if you are planning to set up a buy-to-let limited company for your investments. And you may already have a property, you may be looking to purchase new ones, and we'll be looking at a few examples and case studies where it's more appropriate, where it might not be worth it, depending on your situation. And then we'll spend a bit of time looking at market trends. And right at the bottom there, I think there should be, if I can, there we go. We've also got a Q&A at the end to finish off. Perfect. Nice. So we'll jump in. We'll start with some of the pros of setting up a buy-to-let limited company. So I'll pass over now to Eamon from Taxed.
Great stuff. Thanks, Arch. I guess just before I kind of crack on with some of the pros and a quick introduction to who I am. So I kind of trained up in tax accounting at PwC before myself and Arj set up Tax, which is essentially a software to help you guys with your filings, whether it's a self-assessment, landlord return, being a UK resident or non-resident overseas, as well as limited companies. And we spend a lot of time helping landlords with their structures, how to be the most kind of tax efficient going forward, because as many of you are probably aware, every case really is kind of unique. And depending on your goals with property, the way it should be structured and how you should make your investments will differ. So I guess to start off with, we can look at the positives of kind of purchasing a property through a limited company. Now, one of the first benefits is always with any company, right, that you have that kind of separation of risk, where the kind of company is liable for any issues you may have. The ownership lies with the company, and you as an individual are kind of risk-free and kept separate. And then the major benefit and talking point is always going to be around tax and mortgage interest relief. So as many of you are aware, the kind of legislation with Section 24 meant that mortgage interest was no longer a deductible expense. So obviously back in the day, pre-2018, you could obviously deduct the entire mortgage interest and therefore reduce your rental profits for taxation. Now you are capped at 20% of the mortgage interest, meaning once you go into that 40% band, then there's a kind of additional tax payment you'll be making when holding property in your name. So what a lot of people do is they move the ownership into a company where you fully reduce that mortgage interest, bring the profit down to as low as possible, and then you only pay corporation tax on that profit. Now, it's really going to come down to individual circumstance, because depending on what your other sources of income are, is going to determine whether you actually benefit from the tax saving or not. Now, if you have other UK sources of income that have pushed you into that 40% band, so for example, you have maybe other properties in your name and you're already generating rental profit of maybe 40,000-50,000, or you have other kind of employment income or dividends, etc., from the UK, then it may make sense to move into a company because you'll go straight into that kind of corporate tax rate. However, if you have no UK income, then you may find that the initial benefit of a company doesn't make sense for you because you actually still have your whole 20% tax band available. I can see a question in here from Mark around there we go, lovely stuff. Does it make it more problematic to have a property in a UK limited if the owners are non-UK residents? So the answer is no. It doesn't make it more problematic from a taxation perspective. Tay and Patrick may give some points around getting mortgages, etc., if that's required. But in terms of a taxation perspective, absolutely not. It's actually a very common method for many individuals overseas for buying property. And I guess it links into one of the other benefits as well, is that you sometimes find that if properties are being sold, if they are held within a limited company, the sale process is much easier because you are essentially selling a company, and it's not a property sale, it's a company sale and an exchange in shares. Whereas if you are to sell the property in your own name as a non-resident, you would have to do a kind of non-resident capital gains tax return within 60 days of sale. So there can be some differences there, but overall, it's not more problematic. It's fine. If you are distributing income from the company to your personal name, then you would still need to show this on a self-assessment. So, for example, let's just say you've got £20,000 of rental profit in the business. You pay your corporation tax, and you're left with 16k free cash flow. Let's say you send 15 back to you personally overseas. You would still need to record this on in the self-assessment as a dividend payment, but it would not be subject to UK taxes if you are a non-resident. So yes, I guess that kind of links into some of the other pros, which is flexibility with distributing income, with dividends, director loans, putting different people on payroll, and also kind of the tax planning, as we mentioned, with selling of shares. Second question. Yeah, cool. So I'll get on to Mark's. In terms of why you shouldn't use a company, of course, probably one of the main points, especially if you're a UK resident, not so much an issue if you're a non-resident, is when you come to sell the property, you are going to have, obviously, if you've got a gain on the property, you're going to have that in the business. So that's going to be, taxable at the corporation tax rates. And then what's left over still needs to be distributed to you personally. So if you are selling a property and repurchasing something else, then it's not an issue if you keep it within the same company. But if you're looking to sell up and actually liquidate these properties, you're going to have the money in the business, and then you need to pay the dividends to yourself. So if you're a UK resident, that's going to bring up further personal taxes. But if you're a non-resident, it at least will not bring any UK taxes on that part. Of course, there's some annual charges if the property is worth over half a million. It's known as the annual tax on dwellings, and there's a kind of a scaling annual rate based on the value of the property. And then, of course, you also have to make sure that you're keeping up with your director compliance and doing kind of the annual accounts and corporate tax return, which typically is a lot more burden and cost, which is, I guess, where we come in as well now with a kind of tech solution to help there. But you do have to do yearly accounts and corporate tax return. I've just seen a couple of questions come in. I'll go from bottom to top. Cool. How easy is it to transfer a property? Yeah, so I guess this is a tricky topic, and typically it is quite expensive. I mean, in most cases, you're usually advised to purchase new property within a company rather than transferring existing, because you will essentially be making a sale to this new company, and therefore you will have to look at the kind of the market value of this property, and you will incur kind of stamp duty charges and obviously the legal fees that come with it. So in most cases, it's better not to transfer existing properties, as when we look at the cost of transfer versus the cost of saving, it usually takes a number of years to recoup that initial cost. So again, it comes down to those personal circumstances of how long you look to hold the property. If it's part of a very long-term plan, then sometimes it's worth to make a little bit of a hit up front for the longer term benefits. There was some, and still today, there's sometimes a solution where property is moved into a partnership, and then a couple of years after from the partnership incorporates into a business, and can therefore kind of avoid the stamp duty. But that is kind of a gray area. Not sure how long it would last, but there are options there. So definitely something we can discuss. I guess as a very overall answer is usually existing property should keep as they are and just look at the new purchases. I guess in terms of inheritance tax, there was a question there. Just a caveat: it's not our specialty, inheritance tax, but the general rule is it's going to stay fairly similar, whether you leave a property in a company behind or property in your name. Typically, as you probably know, there's a 7-year rule where any transfers or gifts you make to, let's say your children, as long as you kind of outlive 7 years, then that will be tax-free from inheritance. It's known as a partially exempt transfer. And that is what a lot of people do in terms of moving over. So they would start to essentially gift the shares of the company to their children, and then after 7 years, the tax is kind of exempt. Otherwise, when you incorporate the company at the time of incorporation, you can put equity into your kind of kid's name, so they have ownership right away, but you can change the class of the shares. So initially, obviously, your class may be higher and control the business. So there's a few ways around that as well. So perfect. And another question was around the difference between if you've got buy-to-let and holiday let properties in the company. It's not too different, and you can mix what you do. I think ultimately there will be, for example, when you're looking at revenue expenses versus capital expenses, there's a little bit more of an allowance on what you can expense with holiday let properties. So you would treat them separately in terms of calculating the rental profits, but you can still combine them together into the same company. So not really much difference there. I guess the only point is, and it would be something actually we could talk about afterwards, Mark, but obviously with holiday let properties, they are typically looked at as trading as opposed to investment. So in trading companies, if you are to sell that business or pass it on, it doesn't have the same tax hit as a buy-to-let investment company. A buy-to-let investment company, you wouldn't get entrepreneurs relief, you wouldn't get business asset disposal relief if you were to sell that business, because it's not looked at trading. So you'd be able to mix them from an income and tax perspective and filing, but from an efficiency, and if you were to look to sell or exit, you may want to separate them into two separate businesses with maybe a parent company. Great. We can jump over to you, Arj, on the next bit. I will look at some other questions, maybe type, just so in case we run out of time. Thanks a lot.
Lovely. Thanks, Eamon. Awesome. So let's jump into the next slide around how to decide if using a limited company is right for you. And we've just had a few questions just in terms of loaning money into a company. And I guess just to cover this off before we jump into the next slide, when you are using your own capital to purchase a property, that could be for either a cash purchase or a money upfront, and then you get a mortgage. So the money that you put in upfront would be treated as a loan to the company, so that can be withdrawn tax-free. You can, in some cases, also charge interest to your company at the market rate to then also obtain extra income from that, but you would obviously report that as interest income too. So in kind of both cases, that loan will be tax-free, paid back to you, aside from interest if you were to charge it on as well. So that is if you are non-resident or UK tax resident, that is just tracked on your company accounts as a director loan. Perfect. So I guess we've certainly seen in the last few years more and more kind of buy-to-let limited companies being used. I had a question in the quiz around how many companies have been set up. I think at the moment we have 500,000. It's funny because since 2020, 250,000 have been set up. So over 50% of these buy-to-let limited companies have been set up within the last 4 to 5 years, which shows for a lot of people it's becoming right for them to use it, and they've seen the kind of benefits in the last few years, especially because of their mortgage interest changes, etc. So things that you should be thinking about: how much income you're currently making from other sources. Now, this is in your personal name, how much are you making, and from a UK perspective. Now, obviously, as an overseas landlord, in general, you're going to be non-resident and only taxed on your UK sourced income. Your UK sourced income would be UK workdays, UK rental property, etc. So how much income are you making from a UK perspective? Are you in those higher rates? Are you above your personal allowance? Are you getting a personal allowance, etc.? And we'll take a look at a few of those examples within the case studies as well. Do you want to live off the property income? Is it something that you will be withdrawing from the company? Or would you leave the profits in the company for a future investment, future plans, etc.? Are you using mortgages? Because you can claim the full mortgage interest relief, which is also key if you do have a few properties, potentially in your personal name, you've hit the higher rates of tax. That's where using that full mortgage interest has a huge impact, especially from the 20 to 40% tax rate. And I guess just in case we're not aware, the change in terms of mortgage interest is that currently landlords in their personal name that own residential property can only use 20% of the mortgage interest amount as a tax credit. Now, what that means is you're taxed on your rental income, and then you take 20% off the mortgage interest to reduce your tax bill. So you're effectively being taxed on revenue and not necessarily your profits, especially if you're a higher rate taxpayer. And then the final one to be thinking about is, what's the exit strategy? What's the longer term plans when it comes to your rental properties? Are you going to keep them and kind of pass those down? Are you planning to buy and sell, almost flip the properties after a few years and take the capital appreciation too? Depending on that plan, you may choose that it's kind of better to keep it in your personal name, or it's better to use a company for that additional flexibility longer term. Let's then jump into the next section, our first case study. So I'll pass over to Tay.
Thank you, Aj. I'll just give everybody a really brief introduction about myself. My name's Tay Kavanagh, and I'm the Managing Director for Complete RPI, which is a UK lettings and management business founded in 2001. So we have offices in the UK and in Hong Kong, and we basically manage properties UK-wide, which means, except for Scotland actually, which means that you'll have one point of contact if you're our client, regardless of where your property is located. So Aj and Eamon have actually taken you through the pros and the cons of using a UK limited company. I wanted to take you through sort of the property investment life cycle and see what the differences are with holding a property, say in a limited company versus in your own name. So firstly is the purchase stage. So I've been an investor in the UK property market for over 25 years. And in that time, I've purchased in my personal name through BVI companies, as well as limited companies. Before 2017, the interest expenses, Arj mentioned earlier, the interest expense, landlords were able sort of to claim this 100% against their sort of income, regardless of the vehicle that they use to purchase in. So the tax benefits now is very much restricted to a limited company. And that's the main reason why investors, and we've seen this with the landlords that we manage, they've all gravitating towards holding properties in a limited company, because it does have a huge impact on the net profit that they make each year. So those that have purchased properties in their personal name, myself included, we've unfortunately found ourselves post 2017 paying taxes on monies that we haven't actually earned, because we have been capped at the 20% tax credit, as opposed to claiming the 100% interest deductibility on the interest expense. So a lot of our landlords, I mean, they do ask, is there, this question was raised earlier, can they actually move the ownership from the personal name to a limited company without incurring that double stamp duty? Obviously, some people that have held London properties for a very long time, the stamp duty with the increase in the market value of London properties would mean that that stamp duty would wipe out sort of the benefits of claiming that full interest expense. So the answer to that is yes. We've had a lot of clients that have done this. We work with partners who are able to do this. So if anyone on this call is interested, please do just connect with me, and I'll be able to put you in contact with the partners that we work with. In terms of purchasing, our landlords typically purchase set up one limited company per property purchase. If it's an investment, it's so much easier for a buyer to buy that one property, as opposed to having two properties. They might be located in different areas, and you're then looking for a buyer that wants to take over the entire sort of your portfolio, as opposed to just buying that one investment portfolio. So it's one limited company per property. So the second stage is the mortgage stage. So it probably goes without saying that mortgages in your personal name, you'll be able to find products with lower interest rates and setup fees than if you were looking for mortgages in a company. So mortgage products for companies are typically less expensive because, as we mentioned, there's that corporate veil of limited liability, which means that as shareholders, you can actually hide behind some protection. And therefore, mortgage companies feel that by lending to a company, it is slightly more risky. But I do think that mortgage products for companies will become a lot more accessible and a lot more competitive going forward, just because I think mortgage companies know that investors are setting up limited companies to make use of the tax benefits, as opposed to hiding behind anything. So in terms of profitability at the mortgage stage, I think you need to really weigh up whether sort of the lower interest rates that you can get in your personal name, sort of whether that outweighs the tax benefits of being able to deduct 100% of the interest expense under a company structure. So during the holding stage, which is when the property is let and sort of managed, like in my personal opinion, this is where the landlord or the investor makes their money, right? The longer you can hold your property, the UK market is time and time again shown that typically, if you hold your property for a 10-year period, it should come close to doubling in value. So this, a lot of people trade in and trade out of their properties. And for me, being I would say, dumb, inactive investor, I've seen people who do nothing and they hold their properties over a long term make a lot more money than people who trade in, trade out, trying to time the market, as well as trying to sort of find the best or the next sort of hotspot. So the whole period is actually where you make your money. So basically, if you hold it in your personal name, you'll obviously need to file self-assessment with HMRC. Otherwise, if you set up a company, you'll need to file your accounts with Companies House and submit the corporate tax return with HMRC. So at tax year end, we provide our landlords with the annual income and expenditure statement, which basically captures their income and expenses for the year. If they hold multiple properties, we consolidate this reporting, so it makes them easier for them to file their tax return. So if you're currently using Tax's online platform to file your tax returns, I mean, you probably realize how easy and intuitive it is to file. I mean, I'm actually a CPA, and I've been doing UK tax returns for clients, for family members for over 25 years. And I found that with the tax platform, it's actually the easiest that I've found, which sort of enables people to do it without, at a really very unbelievably low cost, without having to sort of hire an accountant to do it. And what's sort of really exciting for us is that we're actually integrating our system with tax so that all complete RPI clients will have their tax returns prepared and ready for their perusal at the end of the tax year, should they want to sort of take out this service. So I think given tax platform, the obligations under your personal name or under a corporate structure is very manageable because their platform makes it really easy. So as Arj mentioned earlier, with resales, there will come a time when you want to exit your property and sell it. So if you purchase your property in your personal name, you'll have to pay capital gains tax on disposal. So capital gains tax is charged at 18% for basic taxpayers or 28% for higher taxpayers. That could increase. So these taxes are payable on sort of the profits earned on the property minus by your capital gains tax allowance. So you just got to make sure that you report your profits on the capital gains tax return within 60 days post completion. So if you purchase in a limited company, you have the option of selling your property to a new purchaser, or, as Arj mentioned earlier, transferring your shares, which will mean, attract a much lower stamp duty for the purchase of 0.5% of the total consideration of the shares. So you don't pay capital gains tax if you own it within a limited company. You pay corporations tax, which currently stands at 25% for the 24-25 tax year. So in summary, when I'm looking to buy a property, I look at each stage of the life cycle of the property investment, and I see the impact of what different taxes will have, and also the mortgage products will have on the profitability of my investment. Thank you. Any questions? Okay, so we've got a question here called...
So yeah, this question, I can quickly make a comment on it. So in terms of the benefit of one company per property versus one company holding all of them, I guess it's just ease of sale, right? If you have each property in one company and you want to just sell one of your properties, well, then it's a lot easier to sell because you've only got to sell that one company, and therefore you can basically sell the company for kind of the value of the property. It's an easy valuation, and you can probably get a deal done a lot faster. If you have all of your properties in one company, obviously it's going to be extremely hard to sell, because you'll have to maybe sell a portion of your company which relates to what that kind of property is in the portfolio, or a different company would get shares of the main one. It's going to be very difficult to sell. So you're probably the portfolio as a whole, and sometimes you do see this. I mean, Tay would know a lot better than me, but I've seen a few people sell companies that hold 10 to 12 properties as a bundle, and it's like one investment product, and they have got it up to, let's say, 12% annual yield. So then they make a value of the company based on the yield it brings in, and you have less risk because you're buying a portfolio as opposed to buying one property, where obviously if there's any tenant issues, etc., you're kind of 100% in that one. So I guess it depends on the appetite for who you're selling to. If you're looking to sell to larger scale investors who are actually looking to buy a portfolio, have risk diversification, you could argue that if you've built up a company that holds a mixture of freehold, leasehold properties in different areas, and you've managed to get a lovely blend of, you're getting a great yield and you've also got a good forward appreciation, and you've managed to actually make a tailored portfolio, then you probably are going to be able to sell that in a quite unique position to sell it as an investment product. But for that's obviously quite rare for the general investor. for speed of sale and ease, you probably would have one company per property. And again, it just links back to what's been said by both Tay and Aj. Completely depends on your exit strategy. If you are building a very long-term portfolio, and this is for kind of retirement, and this is for the kids in the future, well, then it could be easier to combine them in one, because the idea of selling isn't really important. But if you know that you might be selling within 5 years or 10 years, because maybe you've bought an off-plan property and you've got discount from the developer, or there's been some work done, then you would want it. So that's the overall gist on that. So I guess one company per property just helps the sale. It's a lot easier. I don't know if you'd add anything to that, Tay.
No, I would agree with that. I think what we've seen is people that buy within the one development typically hold it. We've seen a hold it within one company, or it needs to be within a sort of small, if it's just a Manchester-based portfolio, then they may sort of put it all in there. But if it's across the country, then it's not ideal.
Mm-hmm. And what you can also do is have separate companies per property, but have one parent company that owns them all. So you will still get the benefits of sharing any profits and losses across your portfolio, because all of the kind of gains or losses will go into that parent company, and that's where you'll pay the overall tax. But if there does come to a point of selling, you can just flick off one of the subsidiaries. So if you have, let's say, 3, 4, 5 properties, you can have them all owned individually with your holding company as a top level. So that gives you all the benefits of combination, and also the pros of selling, in both cases, selling one or selling the portfolio. Perfect. Cool. Perfect. So we will also look at 1 or 2 more case studies that kind of myself and Aj put together, which we see a lot of from our platform and customers in general. So this one's kind of a non-UK resident based in Hong Kong, so wouldn't get kind of the UK tax-free personal allowance. Already owns 2 UK properties in the personal name, and planning to purchase 1 more. But this new purchase is with it's a joint venture with a business partner. So this would kind of link into those points I spoke about before, with whether mortgages are being used, what's the long-term plan with the property, is this the start of something bigger? Now, typically, if someone owns 2 properties in their name already, then what I would straight away be thinking is, okay, if they were to at one point decide to exit and sell all of these properties together, then from a capital gains perspective, all the lower rates and the allowance is probably going to be used by one property. So they're going to be charged quite a lot overall from a sales perspective. So in that regard, we would push towards a limited company, because if there is any kind of sales made as a non-resident, the distribution from a company would be in dividends, and therefore disregarded and not taxable. And then, of course, we would be looking at, for example, the current rental profits from the 2 UK properties, where they sit within the basic rate band. Is there still a lot of room left? And therefore the profit from this new investment is going to keep the investor in the basic rate, and therefore only paying kind of 20% tax. If that's the case, then and the idea is for a very long-term plan, then maybe you would say for this one that you could keep it in your name if there's no plan on selling. And obviously from a joint venture perspective, it would just be like buying with anyone else, like a family member, etc. You would have kind of a 50-50 split or whatever it is based on the investment. So that's probably how we would look at at this one. In short, looking at, is the rental profit from the current two under kind of 30,000 or 20,000, which gives a lot of room. Also, we'd need to think about things like inflation and rent going up. Are the profits going to increase more significantly within the next few years? And what's the area looking at, so that it's not a tax benefit, for example, for 2 years, and then on year 3 you get stung. Perfect. Just seen a question come in here. So this actually depends where you are resident or national. So for a lot of people, you would receive the personal allowance, and for some people you wouldn't. It just really depends on your nationality and residence. So for kind of all UK nationals, even if they live overseas, they will always get the 12,500 tax-free allowance. If you're kind of a national and resident of a country in the European Economic Area, you would still get your tax-free personal allowance. And there's some countries where you wouldn't get it, such as like USA, Hong Kong. So what you can do is you can actually, perfect. I'll just dropped a link in there where you can check based on your nationality and residence if you are entitled to the tax-free personal allowance. Cool. And then the next case study is actually, as we were just saying, a tax resident of the UAE, but a UK citizen. So gets the 12,500 allowance, has one property in their name, and plans to return to the UK. So in this situation, it would obviously make a lot of sense to not incorporate. There's only kind of one property, and the full personal allowance is being received. What you've also got to consider, especially when you live overseas, is the local domestic legislation of tax, right? So if you are getting tax savings in the UK, it doesn't necessarily mean that you're going to benefit much, because you might get stung where you are living. Obviously, the UAE is a great example because currently there is no taxation on rental income. So we always say if someone's in the UK, then they should keep the property in their name. Typically, a lot of people are moving to the UAE or wherever, and they have one property, and then they they rent that out because they used to live in it, and now they rent it out. It's always beneficial to keep that in the name and make use of the personal allowance, because there's no tax, right? In some countries, yes, from a UK perspective, your rent, or a lot of your rent profit, may fall into the 12,500 allowance. So from a UK perspective, your tax is very low. But because you are resident in, let's say, Germany or wherever, you have to report that entire income as foreign rental income. So then your profit is taxed at your local marginal rate in Germany, let's say at 45%. And just because you have a tax saving in the UK, you just end up having to pay more tax abroad. So it's very important to understand your local domestic tax as well, because if you are in, let's say, a country like Europe, where you are a country in Europe where you are going to be heavily taxed, well, then it might make sense to purchase the properties in the company, leave that income in the business, because then that is not reportable in your personal name overseas, because it's a separate company. So yes. And the final question, what if you own more than one property? The allowance does remain the same. So this 12,500 stays the same. So if you're 2 properties, you would combine the rental profit of the 2. And just a quick note for Hong Kong specifically, there's no tax on dividend income. So limited company would obviously be more favorable, because if you're receiving that income in your personal name, you're probably going to be taxed out there in Hong Kong. But if it's in the company, you're paying dividends, you wouldn't pay tax in the UK, and you wouldn't pay tax in Hong Kong. So that's why it's important, depending on wherever you're based, to speak to a tax expert from both jurisdictions. And there's usually a way that it can be set up to obviously minimize your costs and maximize your tax efficiency. Perfect. I think now I'll be handing over to Patrick, who's also part of Complete RPI, who will actually give some more general information around the trends in the market. Thanks, guys.
Thanks, Eamon. Yeah, look, firstly, let me introduce myself. I work alongside Tay. I'm the Business Development Director. Worked in property for 20 plus years in the UK market, in rental management and property sales. So today we just want to give you a bit of a brief update on the market, the rental market and the sales market. So look, rental market first. Average rents, we've got average rents across the whole of the UK at a little over £1,200, which is up year on year versus this time last year. A little bit more detail, we have London average rents at 2,100, just above that. The average Manchester rent at just over almost £1,100 per month, and the Birmingham average rent at £950. So things are going in the right direction. They're up on last year. The rental growth has slowed slightly this year so far. 2023 was a real booming year for us. Rents were going up at extremely high rates. They have slowed slightly, slowing to around plus 5%. But the market is still very, very busy. To give you an idea, at the moment on competition levels, we have on average 15 households per rental. So that means for every property we put on the market, we've got 15 inquiries for that, and that's double the pre-pandemic levels. So that just goes to show you, there's a lot of competition out there. There's still a lot of people looking for rental properties. Saying that, supply is up. It's 18% up year on year. So that just shows the supply is going up, but the demand is outstripping the supply. We don't see that changing anytime soon. We're just simply not building enough property in the UK, and we don't see that changing. The developers and home builders are just not keeping up with the demand. So that's only a positive really for investors such as yourselves. And like I said, we don't see that changing anytime soon. We think next year there won't be much change really as well. Rents should keep continuing. Growth is slow, like we said, in 2023, but the rental market's still very strong, and we expect that to continue. So that's great news for everybody involved. We've got a slide here for the sales market update as well, if you don't mind. Okay, so we've got the average house price in the UK at the moment is sitting at just over 266,000. Again, to give you a bit more of a breakdown on that, it's a very general figure. The average London house price is currently sitting at just over £700,000. In Birmingham, it's roughly 250,000 average price, and in Manchester it's 263,000. So yeah, that gives you an idea on if you've got property in those particular cities. So 2024 price growth, it's currently 1.4% up year to date. By the end of the year, we're forecasting that to be 2.5%. Projected volume of sales around 1.1 million by the end of 2024. That is roughly, I believe, around 10% above where we were in 2023. So, sales volumes are up, which is great news. We seem to be bouncing back, although be it slowly. I think it's the beginning of good things to come. Now, this is the stuff that's really encouraging. Buyer activity. We've got inquiries up 19% year on year after the Bank of England rate cut. So, I think people have been potentially sitting still a little bit and waiting for the Bank of England to start cutting the rates. And as soon as that's happened, we've already seen a spike in inquiries. And with that, sales are up, sale agreements are up, plus 16% versus last year's high. So, we've got activity up, we've got sales being agreed up. interesting figure that I wanted to share with everybody as well, if you are thinking about selling at some point. So if you do price the property at the actual right price, now there may be some agreement or disagreement on what the right price is, but if the unit is priced right and there's no price change online, typically the average home sells within 28 days. If you're given a price and you say, I want to go higher, I want to test the market, then that actually means typically that it will take 73 days to sell your property. So I guess what we're trying to say here is that it's really, really important that you put the property on the market at the right price, because it can practically triple at least double the time that it would take you to achieve a sale. So the market's still very, very price sensitive, so it's something to definitely consider before you do put it on the market. The market in general, look, rates are coming down. I think the outlook is starting to be positive. It's been a tough few years in the sales market, but rates are coming down. Inquiry levels for buyers are coming up. Sales being agreed are starting to increase. It's showing some green shoots, as we say. Like things are starting to improve. It's still early days, but our advice to a lot of our clients right now, myself and Tay, we're saying to people, look, let's do some valuations of your property, see where we are right now, and we're hopefully expecting another Bank of England cut at some point, hopefully this month. And if that happens, interest should keep creeping up, and sales should keep, more sales should be agreed. And I think, probably by spring next year, hopefully, the sales market's back, and that's probably the timing we're giving our clients. Early next year to spring next year would be a great time to, if you are considering selling, that would be a great time to do it. And what I would say is, I know these are very general figures, it gives you a bit of a snapshot of things, but if anybody does want a specific valuation on a property that they hold, for rental valuations or for sales valuations, Tay and I are more than happy to do that free of charge. Doesn't cost you anything, and it's always a good idea to get an idea on where you are at least every couple of years with regards to values. So we're more than happy to do that for you. Thank you.
Awesome, thanks Patrick. And just into the final section, a bit of a Q&A. So feel free to drop any queries through onto the chat, and we'll be able to get through to them. I guess as well from a tax perspective, just from sentiment, not so much stats, but we've certainly seen a lot of landlords in the UK and abroad selling their properties. I think I've had to do a lot more non-resident capital gains tax returns in the last few weeks. But yeah, I think as well we're kind of seeing a lot more hesitation as well, from potentially tax rates going up, capital gains potentially increasing from next month. So we'll see what happens there. I guess just in terms of queries, we've got one through here. Is it easier to sell into a company if you are leaving and renting it out? Now, in general, I guess this kind of comes into the queries around the stamp duty and capital gains on that transfer of ownership from personal to a company. So in general, if you are going to have that stamp duty and capital gains, it's probably not going to be worth it unless you have the portfolio and you can go down the incorporation relief route, where you move it into the company without that stamp duty and capital gains. I guess in general as well, though, if you have lived in the property, you may also have PRR, so private residence relief, which means that essentially for the time or for the period that you've lived in the property, there's no capital gain there. So that's if you are leaving that property itself. And another question, if you have any questions to follow up, feel free to drop us an email at contact@taxed.co.uk. I'll add that into the chat as well. So you've got the email that you can drop us a message on. We've got a new query here from Tom. Is there any issues when buying together with a non-resident citizen and resident citizen. So I guess that is a UK tax resident and a non-resident. And I guess from a tax perspective, there's no issues there. I guess when it comes to distributing the income afterwards from the retained profits within the company, if you are non-resident, there wouldn't be any UK tax on that kind of dividend. But if they are a UK tax resident, then there would be. So I guess there's just kind of personal income tax rates would be different if you're non-resident versus resident, but from a overall tax standpoint, it's all good.
And also, you guys, Tay and Patrick, perfect, just gone.
Yes.
The emails in there for any queries for the RPI as well.
Got a question here. So if you don't have PR and have properties in your personal name, does it make sense to move them into a UK limited co from a tax perspective for a non-resident?
Again, we'd have to read into this in a lot more detail. Straight off the back, probably not, based on the kind of stamp duty charges, etc. And obviously, it depends as well where you've moved to and what the domestic legislation is there. So a short answer would probably be no, because you don't have PR. So it's going to be more costly. But it depends. Yeah, definitely not in the UAE. I wouldn't recommend that at all, because the income in your personal name there is not taxed in the UAE. So any rental profits you're getting in your personal name aren't going to be taxed out there. So you'll get kind of the allowance in the UK if you get that. If not, the profits would be capped at 20% tax. So it would also depend on the total amount of rental income. If your profits are within kind of 37.7k and you're in the 20% band, then I wouldn't recommend moving them into a limited company.
Perfect. We have a question here around how do you find what the value of the property was when it stopped being your personal residence to calculate capital gains tax? And I guess from a capital gains tax perspective, we would look at two things. One is the value of the property when you purchased it and then when you sold it. But also if you have been non-resident and owned the property prior to 2015, we look at the 2015 market value. Now, how you obtain that could be using an agent to help you to work out the valuation at that time, at April 2015. We don't necessarily look at the value of when you leave the property. We use the months or dates that you've lived in the property to claim relief, but we don't necessarily look at the value. So you get the relief based on time, not the amount that it was worth.
Arj, sorry to interrupt you. I'd say we do get that request quite a lot, actually. Clients of ours asking for capital gains tax valuations, and kind of what you touched on. What we do is we look at comparable information, what was sold in, ideally what was sold in your actual block or next door or on your road or on your street, and we kind of build evidence to say this is what we think the property is worth. So we can certainly help you with that. If you need some help with something like that, please feel free to get in touch, because we do that quite a lot. So yeah, happy to help.
Back on the topic of company per property, generally what are the costs of running a limited company, as don't you need a registered address, accountant, etc.? Now, I guess that's a great question and kind of comes nicely onto a new product that we've launched at Taxed, which is the file the company accounts, the office, etc., for a buy-to-let limited company. So in general, yes, you do normally need to have a registered address, but you can use a virtual office. So a virtual office essentially will scan your post, scan any kind of documents from HMRC or from Companies House. And Companies House is where we would register the limited company with. Essentially, those kind of documents get sent to you. And then from an accounting perspective, the costs are, like, from a traditional accountant, £800 plus per year. And that often wipes out a lot of the tax benefits of setting up a limited company in the first place. That's where software comes in. We're able to complete those accounts, corporate tax return, at a much lower fee. So we charge a £30 per month fee, which includes the company accounts, corporate tax, the office, etc. So the total across the year would be 360 instead of the larger accounting fees. I guess just in terms of other kind of admin associated with companies, there's also kind of confirmation statements, etc., which are completed. But yeah, that's all services that we can support with. But yeah, in general, traditional accountants do charge more because the kind of company accounting is a separate entity and often requires more work. And that's where software can come in and try to bridge that gap. Lovely. Any other questions? I mean, at the same time, if you do have any questions for taxed for complete RPI, feel free to drop us an email, message us on LinkedIn, whichever's best, and we'd be happy to support in any way possible. I guess in the meantime, thank you so much for joining. We really appreciate your time, and we'll be in touch. And if you do need any of the slides or of this webinar, it will be uploaded too, so we'll be able to share this with you afterwards. Thanks, everyone. Thanks for joining.
Thank you.
A lot for joining.
And thanks, Patrick. Thanks, Tay. Thanks, Eamon.
Thank you.
Thank you.
Guys.